Welcome back to the Deep Dive.
Great to be here.
So, today we have a topic that is, frankly, just a little intimidating.
Oh, yeah, just a little.
Right. It's thick, it's dense, and it deals with the absolute bedrock of the global economy.
The machinery itself.
Exactly. We aren't talking about the stock market today. We aren't talking about, the latest crypto coin that just pumped 50% overnight.
Thankfully.
Yeah, right. We are talking about the actual machinery that allows all of that other stuff to even exist.
Mm-hmm.
We're talking about the global movement of fiat currency.
It's the water that the rest of the financial world swims in.
Right.
And usually we completely ignore the water until we're drowning in it.
We really do. And I want to start with a bit of a provocation for you listening right now.
Okay, lay it out.
So picture this. You're sitting at your desk, or maybe you're at the airport, right? And you look at your phone. You check a currency rate.
Like checking the euro before a vacation.
Exactly. You're planning a trip to Europe. You look at the euro, or maybe you're just watching the yen because you trade a bit, and the numbers are flashing.
Red, green, up, down.
Right. Ticking away. And I want to ask you, why do you think those numbers actually move?
That is the ultimate question.
Yeah.
And it's the question that, honestly, most people get totally wrong.
Because most of us think it's the breaking news.
Of
Right?
course we do.
Like the inflation report that dropped 10 minutes ago, or some angry speech by a politician.
Or a war headline flashing across CNN.
Exactly. It feels like the market is just this twitchy, nervous animal reacting to loud noises.
It feels that way because, well, that's how we are wired to perceive it.
What do you mean?
We see the rock hit the water, right, the headline, and then we see the splash, which is the price move.
Right. Causality.
But the reality of what we're breaking down today is that the splash is just a massive distraction.
A distraction.
Yeah. If you really want to understand the ocean, you don't stare at the splashes on the surface. You have to look at the current deep underneath.
The thing moving the water long before the rock ever showed up.
Precisely.
Okay, so we are dissecting a concept today called the multi-month FX campaign.
Yes.
I just have to say, I absolutely love the terminology here. A campaign.
It's evocative.
It is. It sounds military. It sounds so deliberate.
Well, it is deliberate, but we do have to be a little careful with that word.
How so?
Because it isn't deliberate in some sort of conspiratorial way.
Oh, like guys in a smoky back room.
Right. It's not three guys in a dark room deciding to crash the British pound for fun.
Okay.
It's deliberate in a structural way. It is a massive long-term arc of capital reallocation.
Reallocation.
Yeah. It isn't just a line on a chart. It's not a knee-jerk reaction to a single event. It is a slow, methodical process.
So why this matters to you, listening to this, most of us are constantly just reacting to history.
We're chasing the tail.
Right. We see a trend, we chase it. We see a crash, we panic.
And usually lose money doing it.
Exactly. So the goal today is to give you the X-ray specs. We want to stop looking at the skin of the market and really start looking at the skeleton underneath.
I like that analogy.
We are going to break down the actual anatomy of these massive moves so you can stop reacting to all the noise and start recognizing the actual process.
Because if you can understand the anatomy of a campaign, you stop asking yourself what just happened and you start asking, where are we in the cycle?
Which is a much more profitable question.
Exponentially more profitable.
Okay, so let's unpack this, because I think the first big hurdle we have to get over is just how we've been trained to think about markets in general.
The storytelling aspect.
Yeah. Section 1 of our deep dive today is narrative versus structure.
The narrative fallacy.
Right.
I mean, we are storytelling creatures by nature. It's how we make sense of a chaotic world.
Sure.
But in financial markets, specifically foreign exchange, it is almost always a trap.
Walk us through this. How does the narrative usually work when we're just casually watching the news?
Well, think about your typical morning routine. You open a financial app on your phone. You see the dollar is up 0.5%.
Okay.
Immediately underneath that ticker, there are 5 articles explaining exactly why.
Right. The dollar went up because of the jobs report.
Or the euro fell because of political uncertainty in France. It is always presented as cause and effect. A plus B equals C.
And it sounds so perfectly logical. I mean, the data came out, the price moved. What's the actual problem with that?
The problem is that those narratives usually emerge after the move is already underway.
Oh, like a post-game interview.
Exactly. They are post hoc rationalizations. We see the price move, and our brains and honestly financial journalists too, scramble to find a reason that fits the action.
We just need a reason.
Right. But a true campaign, a macro trend that lasts for quarters, begins way before that narrative ever stabilizes on CNBC.
So you're saying the story follows the money, not
Yeah.
the other way around?
Almost always, yes.
Wow.
The campaign forms when big institutional capital decides that the relative value between two jurisdictions, say the US and Europe, simply must adjust over a long period.
Right.
So the rule is structure is primary, direction is secondary.
Okay, structure is primary. That's a pretty dense phrase. I'm going to drill down on that. What do we actually mean by structure in this context?
Think of it this way. If the U.S. economy is overheating, like it's growing super fast, inflation is rising, and Europe is simultaneously stuck in a deep recession.
Okay, two different worlds.
Right. Capital has to move. It's not a choice. It's a literal requirement of the financial system to seek yield and to seek safety.
Capital has to go where it's treated best.
Exactly. That underlying economic reality, that's the structure. The direction, meaning the dollar going up on your screen, is just the visible expression of that structural need.
I want to use an analogy here because this can get a bit abstract for people.
Go for it.
It feels a little bit like the difference between weather and climate.
Oh, that is a perfect analogy.
All right, so the daily fluctuations like the euro is down today because a central banker gave a hawkish speech. That's just weather.
It rains, it's sunny, it's windy.
Yeah. You might need an umbrella today, but it doesn't actually tell you what season you're in.
Right. But a multi-month campaign, that's the seasons changing. That is winter coming.
Okay.
It doesn't matter if it's a surprisingly sunny day in mid-November. If winter is coming, the temperature is structurally dropping over the next 3 months, period.
You cannot stop the season with a headline.
You really can't.
And this is where the sheer scale of the money comes into play, isn't it? Because we aren't talking about day traders on their phones here.
No, not at all.
We aren't talking about me buying a few €100 for a backpacking trip.
No. We are talking about the true super tankers of capital.
Super tankers.
Sovereign wealth funds. Massive pension funds with 50-year horizons. Insurance floats, corporate treasuries rebalancing billions of dollars to hedge their international operations.
Giant pools of money.
Right. And when a supertanker changes course, it takes miles of ocean.
It doesn't turn on a dime.
Exactly. It doesn't flinch because of a tiny wave. When they decide to reallocate capital globally, it becomes a campaign by default because it literally takes quarters to execute those kinds of block orders.
That's such a crucial point. If a massive pension fund wants to move, say, $10 billion from Europe into the U.S.,
Yeah.
they can't just hit buy on an app.
No, if they did that, they would completely crush the market.
They blow out the price.
They would spike the price against themselves and ruin their own execution. They have to do it slowly, methodically, over weeks and months.
Sneaking it into the market.
Right. And that execution process is the campaign. The campaign is essentially just the footprint of the supertanker turning.
Let's zoom out for a second. Because for this supertanker to turn, or for the seasons to actually change, you need very specific conditions.
You do.
You can't just have a campaign spawn out of nowhere. The framework calls this regime alignment.
Regime alignment, yes. A campaign cannot happen in a vacuum. You need the right soil.
The soil.
If the soil isn't fertile, the trend won't grow, no matter how much water you pour on it.
Okay, so what goes into this soil? There are 3 specific pillars to this. And if you want to spot one of these moves as a listener, you need to mentally check these 3 boxes.
Right.
Pillar 1 is macro divergence.
Divergence, simply put, 2 things moving apart.
Specifically, 2 economies moving apart.
Yes.
This feels like the most obvious one to me. If one economy is doing great and the other is struggling, money moves.
It is obvious on the surface, but it's actually really often misunderstood.
How so?
Because we are usually talking about policy divergence. You have one central bank raising interest rates aggressively and another central bank cutting them.
Right.
Or one economy growing at 4% and another completely shrinking. Think about the U.S. and Japan over the last few years.
Okay, U.S. rates went super high. Japan rates stayed rock bottom. Money flows to the high rates. That's economics 101.
Correct. But here is the crucial detail that trips most retail traders up. Divergence all by itself isn't enough.
It isn't.
No. Markets price in basic divergence every single day. For a true multi-month campaign to kick off, the divergence must be persistent.
Persistent. Define persistent in this specific context.
It has to have real legs. It has to fundamentally justify moving billions of dollars for quarters, not just for a few wins.
Okay.
If I'm a massive fund manager in London, I am not shifting my entire portfolio allocation because of one hot inflation data point in the US.
Too much friction.
Right. I am moving it because I believe the US economy will operate in a structurally different reality than Europe for the next 2 years.
So if it's just a temporary spat between countries or maybe a one-off bad month of manufacturing data, the supertanker doesn't bother turning.
Exactly. It's way too expensive to turn the ship. They need to see a long horizon.
Right.
They need to see a structural, long-lasting shift in the economic landscape.
Got it. So persistence is key for Pillar 1.
Yes.
Now, Pillar 2, this is where we get into the plumbing of the financial system, liquidity and balance sheets, which honestly sounds highly technical and, frankly, a bit dry. Liquidity is one of those buzzwords people throw around at dinner parties to sound smart.
They absolutely do.
But what does it actually mean functionally here?
Imagine you want to pour a whole gallon of water into a cup.
Okay, visualizing the cup.
If the cup is tiny, meaning low liquidity, it overflows almost immediately. It's a total mess. The water goes everywhere, prices spike erratically.
Right.
But if you have a massive bucket-high liquidity, you can pour that gallon steadily for a long time, and the bucket just absorbs it.
It barely makes a splash.
Right. So liquidity simply determines durability.
So for a massive multi-month trend to sustain itself without totally breaking the market structure, you need a really big bucket.
You need incredibly deep, stable funding markets. If the balance sheets of the major banks and institutions holding these positions are constrained, or if they are just scared, they can't absorb the new positions.
And what happens if the bucket is full or just too small?
The move violently snaps back.
A flash crash.
Or just a massive immediate reversal. It can't sustain the weight. We actually see this in emerging market currencies quite often.
Oh, interesting.
A trend starts because of real divergence, but the market itself is just too small. The liquidity dries up instantly, and the currency crashes or spikes violently out of control.
So a true campaign in a major pair, like the euro and the dollar, needs a deep, liquid ocean to absorb that massive flow of capital over time.
It does. You can't build a skyscraper on quicksand. You need a rock-solid foundation to hold the weight of a sustained trend.
Makes total sense. All right, Pillar 3 is the positioning vacuum. And I have to say, this is my favorite one because it is entirely counterintuitive.
It is the contrarian element of the whole framework, a vacuum. Empty space.
But why do we need empty space? Don't we want everyone to be buying the asset if we want the price to go up?
Eventually, yes. But campaigns rarely ever start when everyone already agrees.
Okay.
Think about it. If everyone is already long in the dollar, if every fund and retail trader has already bought, who is left to buy?
Literally no one. The buyers are exhausted.
Exactly. The buying power is spent. So these massive structural moves typically begin when positioning is completely neutral. Or even better, they start right after a previous crowded trade has violently unwound.
Clearing the board.
You need space for inventory accumulation.
Yeah.
You need an empty theater so that you have seats to actually fill over the next 6 months.
So if I'm waiting at the airport and I read the cover of a major financial magazine and it says in bold letters, "The dollar is king," and my taxi driver was just telling me to buy dollars,
The new campaign is definitely not starting.
it's probably ending.
It is almost certainly ending. But we'll get to the end phases later. Right now, we are just looking for the start.
Right.
And the start of a massive trend is usually marked by total apathy or disbelief.
Okay, so we have the soil, we have persistent divergence, we have deep liquid plumbing, and we have an empty room ready to be filled.
The stage is set.
Now, let's talk about how this beast actually wakes up. The anatomy breaks this down into 3 distinct phases.
Section 3. Anatomy phase 1. Accumulation. Or, as I like to call it, the stealth phase.
The stealth phase. That is the perfect name for it, because this is the most dangerous phase for the average person.
Why dangerous?
Because it is completely invisible to the naked eye.
What's the vibe on the price charts here?
Quiet. Boring. Subtle.
Choppy.
Very. If you look at a daily chart during the accumulation phase, it looks like nothing is happening. It's just chopping sideways in a tight range, maybe drifting a little bit up or down.
It's frustrating to trade.
Incredibly frustrating. It shakes out all the impatient money.
But underneath that boring surface?
Underneath, the tectonic plates are shifting. This is where the real institutional action happens.
The super tankers are waking up.
Right. The smart money, the real long-term institutional capital, begins shifting their exposure based on that structural view we talked about earlier.
But they're hiding it.
They have to. Remember, they are super tankers. They aren't going to market buy and spike the price. They are quietly repositioning. So they're buying while everyone else is sleeping, or just while everyone else is bored out of their minds.
They are slowly accumulating inventory. And because they are so big, they use execution algorithms to buy small hidden amounts over weeks and weeks.
Just sipping from the market.
Right. They buy a little, the price ticks up, they turn the algorithm off, price naturally drifts back down, they turn it back on and buy more.
And that creates the sideways chop.
Yes. It creates what we call range compression. The coil is tightening, but it hasn't sprung yet.
But there is a tell, isn't there? There's a fingerprint they leave behind.
Yeah.
The framework highlights something called the asymmetric reaction.
Yes.
I think this is possibly the most practical, actionable tool in this entire deep dive. Break this down for us.
This is essentially the cheat code for spotting accumulation.
The cheat code.
During this phase, the market hasn't formally broken out yet, but underneath, it has already made up its mind structurally.
Okay.
So as an observer, you just sit back and watch how the price reacts to breaking news.
Give me a scenario. Paint the picture for us.
Let's say we are in the early stealth stages of a bullish campaign for the US dollar.
The dollar is getting ready to run.
Right. The structural buyers are there, quietly buying all the dips. Suddenly, a piece of unexpectedly strong economic data comes out. Maybe US GDP growth is way higher than anyone expected.
Okay, so objectively good news for the dollar.
Boom! The price jumps significantly on the chart.
It reacts exactly how it should.
And importantly, it sustains the gain. It doesn't fade. The smart buyers step up aggressively because the news actively confirms their underlying thesis.
Makes total sense. Good news equals price up.
But then, let's say a week later, a piece of genuinely bad data comes out. Maybe inflation is suddenly much lower than expected, which usually means lower rates.
Right, so bad news for the dollar.
Theoretically, if the market was truly neutral, the price should drop hard on that news.
It should tank.
But it doesn't.
It doesn't.
It just shrugs. It dips a tiny fraction of a percent and then recovers almost immediately.
It literally refuses to go down.
That refusal is the asymmetry. Good news pushes it aggressively up, but bad news is completely ignored.
Wow.
That specific dynamic tells you there is a massive structural bid underneath the market just waiting to absorb any selling pressure.
The market desperately wants to go one way.
It's like trying to push a beach ball underwater.
Oh, I love that visual.
You push it down with bad news, and it pops right back up to the surface instantly. But if you lift it up out of the water with good news, it practically flies.
The beach ball effect. That's a powerful image.
Okay.
But the trap here is that at this stage, most casual observers just look at the chart, see it bouncing around, think it's random noise.
They get bored. They literally say, well, the market has no direction right now.
And they walk away.
They walk away right before the fireworks actually start.
Now here's where it gets interesting. Because eventually, that beach ball breaks the surface of the water, doesn't it?
Oh, it erupts.
And that brings us to section 4. Anatomy phase 2. Recognition. The momentum phase.
This is where the entire vibe of the market changes completely. It flips from quiet and boring to loud, fast, and obvious.
This is when my uncle texts me and starts asking about exchange rates.
Exactly. This is the consolidation of the narrative.
What happens to all those financial articles we talked about earlier?
Suddenly, they all line up. The media, the sell-side research papers, the talking heads on television, they all suddenly agree on exactly why the move is happening.
The story finally aligns with the price action.
The dollar is surging because the Fed is hiking. It's plastered on every screen in every trading room.
And because the story is finally crystal clear to the public, participation just explodes.
Absolutely explodes. This is when the systematic funds jump in.
The algorithms.
The momentum algorithms, the trend-following hedge funds, the retail breakout traders, they all join the party at the exact same time.
This is when you look at a chart and you see those clean, beautiful 45-degree angle lines just going straight up.
Volatility expands dramatically, price moves get bigger, and they happen much faster.
It feels really good to be in the trade at this point.
Oh, it feels amazing. It feels completely validated. Everyone on Twitter is patting each other on the back, sharing their winning trades.
But there's a massive perception gap here, isn't there? This is a bit of a paradox.
It is the ultimate paradox of trending markets.
Because to me, standing on the outside, looking at that 45-degree line, this looks like the beginning of the trend.
Of course it does.
I mean, it just broke out. It's moving fast. It looks mathematically the strongest it has ever looked right now.
But structurally, if you look at the anatomy we are discussing, you are likely mid-process. maybe even late mid-process.
Really?
The early smart repricing, that quiet accumulation phase we just talked about, is completely done. Those institutional guys are already sitting on massive profits.
So the smart money isn't driving this part.
No, now it's purely about momentum. It's about the crowd piling in because the narrative is loud.
So if you're entering the market right now, buying the breakout, are you the dumb money?
I wouldn't necessarily say dumb, but you are definitely late money.
You're chasing.
You are chasing the herd. Now, to be fair, you can still make a lot of money in phase 2.
Because it's moving so fast.
Right. Phase 2 is often the most profitable part of the move if you catch it because it is so highly directional. It just goes up every day.
Right.
But you have to fundamentally understand that your risk profile has completely changed. You are no longer steering the supertanker. You are just a guy on a surfboard surfing its wake.
And wakes can get choppy.
Very choppy.
I think we need to ground this. We've been talking in a lot of theory here. Supertankers, soil, asymmetric beach balls.
It helps to have a concrete example.
Let's look at a real-world monster. Section 5, Case Study. The U.S. dollar cycle of 2021 and 2022.
This is arguably the textbook definition of a modern multi-month FX campaign.
It really is.
It had absolutely everything we just discussed playing out perfectly in real time. It serves as an incredible blueprint.
So set the scene for us. Take us back to 2021. What was the world actually like?
Okay, late 2020 into 2021. The world is just starting to come out of the pandemic lockdowns. Right. We have massive, unprecedented stimulus checks hitting everyday people's bank accounts. Global supply chains are completely snarled.
Ship stuck outside court.
Exactly. And suddenly, very quietly at first, consumer inflation starts ticking up.
I remember the buzzword from back then. Transitory.
The infamous word. The Federal Reserve and a lot of economists kept saying on TV, it's transitory, don't worry, it'll pass as soon as the ports open.
But the market didn't quite believe them, did it?
The bond market started getting very nervous. Smart money started to sniff out that the Fed was fundamentally wrong.
The stealth phase.
And then late in 2021, the Fed pivots. They realize, oh, wow, this actually might not be transitory at all.
They panic a little.
They do. They signal aggressive tightening. They tell the market they're going to raise interest rates, and they're going to do it fast.
Okay, so the U.S. is suddenly stepping hard on the economic brakes. What about the rest of the world? Europe and Japan?
The European Central Bank, they are practically asleep at the wheel.
Different problem.
Very different. They are dealing with a looming energy crisis, a war developing on their doorstep eventually, and generally sluggish growth.
So they aren't hiking rates.
They are actively saying, no, we don't need to hike yet. Our inflation is different.
And Japan?
Japan is still doing full quantitative easing, printing money, keeping their interest rates literally below zero. Negative rates.
So there's your pillar one.
Yeah.
Macro divergence. You have the U.S. aggressively hiking and Europe and Japan just sitting there waiting.
It was a massive, historic divergence. The structural alignment for U.S. dollar strength was absolute perfection. The soil was incredibly fertile.
Now let's trace phase one. Early 2021 through the start of 2022.
It started so quietly. If you go back and look at the daily charts from early 2021, the dollar index started slowly appreciating, but it wasn't front-page news.
Just drifting up.
Volatility was low. Many casual observers just dismissed it as, oh, it's just a little technical bounce after the big pandemic drop.
It was the textbook stealth phase.
And we saw those asymmetric reactions perfectly.
How so?
When high inflation data dropped in the U.S., the dollar immediately ripped higher.
Good news, price up.
When a bad retail sales number came out, the dollar just held steady. It barely dipped.
The beach ball.
Right. The smart institutional money was positioning for a world where the Federal Reserve had to panic. They knew the transitory narrative was dead long before the Fed officially admitted it.
And then came 2022, phase two, the momentum phase.
The recognition. Suddenly, policy divergence was literally the only thing anyone talked about.
It was inescapable.
The narrative took over completely. The Fed started hiking rates by 75 basis points at a time. Historic, violent moves.
I remember the headlines everywhere. The dollar wrecking ball.
That was the phrase. The dollar against the Japanese yen accelerated vertically. The euro dropped like a stone, heading straight toward parity with the dollar.
€1 equaling $1.
Yeah.
Which hadn't happened in, what, 20 years?
2 decades. It felt historic because it was historic, and the move became entirely self-reinforcing.
Wait, how does a currency move reinforce itself?
Momentum took over. Because the dollar was going up so fast, it actually caused more inflation issues abroad.
Oh, because commodities are priced in dollars.
Exactly. Importing oil and energy became exponentially more expensive for Europe because their currency was weak,
Which made their economies look even worse.
which made capital flee Europe even faster, which made the dollar go up even more. A perfect feedback loop.
It felt unstoppable.
Yeah.
If you were trading then, it truly felt like the dollar would just go to infinity.
It always feels that way.
But the real story is, that is exactly when the move was secretly dying.
That is the cruel twist of the market.
And that leads us to Section 6 of our framework. Anatomy Phase 3, saturation, the illusion of strength.
This is fundamentally the hardest part of the cycle to spot in real time because it looks exactly like pure strength.
The price is at all-time highs.
Right. The headlines are wildly bullish. Every analyst agrees the dollar is king and will remain king.
But the environment underneath is mature?
It is suffocatingly crowded.
Crowded.
If you looked at the commitment of traders data back then, which tracks the actual futures positioning of funds, everyone was on the exact same side of the boat.
The boat was tipping over.
Everyone owned dollars. Institutional long positions were at record, stretched highs.
And when everyone is already on one side of the boat...
It becomes almost impossible to tip it any further.
Right.
This leads to a critical concept called diminishing returns. This is the exact inverse of the accumulation phase we talked about earlier.
Explain that. How does the market's reaction function flip here?
Remember in the beginning, during stealth, how any good news made the price violently jump higher?
Yep, the beach ball flying out of the water.
Now, in the saturation phase, you get a massive, undeniably bullish news event. Maybe the Fed hikes rates yet again, even higher than expected.
Okay, maximum good news.
And the price barely moves.
It just sits there.
It ticks up a few pips and then just goes flat.
The market is tired.
It's exhausted. We call this the marginal data surprise.
Marginal data surprise.
It means it takes a massive, earth-shattering catalyst just to push the price an inch further. All the aggressive expectations are already fully baked into the price.
Because there's no one left to act on the news.
Right. If everyone already expects a rate hike and they already bought dollars last month to prepare for it, when the hike actually happens today, nobody is left to buy.
They already bought yesterday.
Exactly.
That is a massive warning sign.
Yeah.
If the news on TV is fantastic and the price on your chart is flat, you should probably run.
You should definitely be very, very careful.
And then there's another signal here, cross-asset divergence.
This is a critical diagnostic tool.
The choir stops singing in harmony, right?
Exactly. Usually, in a very healthy mid-stage campaign, different asset classes like bonds, stocks, and commodities, they all sort of tell the same macro story. They validate each other.
But in the saturation phase,
In saturation, the signals start to fracture. You might see the dollar slowly grind to a new high, but bond yields, the actual interest rates that were supposedly driving the dollar, they stop going up. They don't confirm the new high.
the engine's stalled, but the car's still rolling.
Right. Or the stock market stops panicking and stops reacting to the currency entirely.
So the narrative is breaking down underneath the hood.
It is a flashing red warning. The trap here is that the price might technically still be trending up,
Which keeps people buying.
but it isn't being driven by smart institutional money anymore.
Who's driving it then?
It is driven by latecomers. It's a process of redistribution.
Oh, so the smart money, the suture tankers who bought in phase 1, they are actively selling their massive positions to the retail traders who just read the dollar wrecking ball headline in the airport lounge.
Precisely. Liquidity starts to thin out at the top. The move looks strong visually on the chart, but structurally, internally, it is completely hollow.
It's just a shell of a trend.
A shell waiting to crack.
So how does it actually end? Do we get a massive crash? A cinematic explosion? That brings us to Section 7, the termination.
We all love the Hollywood ending, don't we?
Of course. It makes for great TV.
The spectacular crash, the bubble violently popping. But for these massive multi-month FX campaigns, that kind of ending is actually surprisingly rare.
Really? Because I feel like we always hear about currency crashes in the news.
We hear about them specifically because they are dramatic and make great headlines.
True.
But statistically, most of these structural campaigns end with a whimper, not a bang. They end in pure exhaustion.
Completion without collapse. That's a really interesting concept.
Well, think about the fundamental logic. The campaign started because massive amounts of capital needed to reallocate from region A to region B.
Because of the macro divergence.
Right. Well, What naturally happens when that reallocation is finally finished?
The money stops moving.
Exactly. The repricing process has reached its logical limit. All the future expectations are fully baked into the current price.
So the relative value gap has closed.
Yes. The US is no longer that much more uniquely attractive than Europe because the dollar is now so expensive that it perfectly reflects that advantage.
The supertanker has finally arrived at the port. It drops the anchor.
It drops the anchor.
So what does that actually look like on the screen for a trader?
The nature of volatility entirely shifts. It goes from being highly directional, meaning a steady, aggressive uptrend, to what we call two-way volatility.
Two-way.
It gets choppy, messy. It starts violently grinding sideways, up 1% Tuesday, down 1% Wednesday.
So the momentum just fades into this messy consolidation.
Yes.
And the framework mentions that at this stage, quote, logic dissolves. What does that mean in practice?
It means the fundamental narrative that drove the whole campaign, say, U.S. interest rates are higher than Europe's, that fact might still be completely true.
Right. The Fed hasn't cut rates yet.
But the price of the dollar stops caring. It stops reacting to that logic.
That sounds incredibly frustrating for anyone trying to trade it based on the news.
It is the most frustrating environment possible. Policy expectations internally shift. Maybe global yields start to slowly converge again. Or maybe some random external shock happens that just changes the global subject entirely.
So if you are sitting at your desk, shorting the market, waiting for the ultimate reversal signal or the big crash to tell you the bull run is officially over, you might wait forever.
You will just get chopped up in the noise, losing money on endless false breakouts and false breakdowns. The key takeaway from this entire section is this. Campaign completion does not require a price reversal.
It doesn't have to go back down.
No, it just means the macro relocation of capital is finished. The dollar didn't have to crash back to its 2020 lows for the bull run to be over. It just stopped going up.
That is a remarkably powerful distinction to make. It's not about up versus down. It's about active versus complete.
That's the perfect way to summarize it, yes.
Okay, we've covered a lot of ground.
Yeah.
We've explored the anatomy. We've dissected the beast from start to finish.
We have.
But now let's get highly practical. Let's talk about execution. Section 8, the diagnostic framework.
The actionable part.
Right, the so what for our listener. Because understanding the theory is great, but how do you actually use this when you open your laptop tomorrow?
You need a system.
Let's walk through this mental checklist. Step 1, check regime.
You have to ask yourself, is the macro divergence truly persistent?
Are the central banks actually operating on completely different planets right now? Or is it just a temporary one-month spat over minor data?
Exactly. If it's not a deep structural divide, it's not a multi-month campaign, so don't marry the trade. Treat it like weather, not climate.
Got it. Step 2, check liquidity.
Can the market comfortably absorb more capital flow? Is the bucket full?
Right.
If global funding markets are showing signs of stress, or if the asset itself is fragile and illiquid, be incredibly wary of long-term trends. They are highly prone to snapping back and hurting you.
Step 3, check positioning. This is the contrarian check.
Is everyone on Earth already in the trade? Look at sentiment. If your literal cab driver is giving you FX tips on the euro, you are deep in phase 3.
If the financial magazine covers are universally bullish, be careful.
Very careful.
Step 4, check reaction. You called this the cheat code earlier.
This is the big one. Watch how the price reacts to catalysts, not the catalyst itself.
Do strong catalysts fail to move the needle?
Right. If amazing good news doesn't push the price higher, the campaign is saturated. The buyers are exhausted.
And inversely, if terrible bad news is completely ignored by the market, the campaign is in the stealth accumulation phase.
The beach ball. Watch the reaction.
And finally, step 5, check confirmation.
Do the other major asset classes agree with the currency move?
Bonds, equities, commodities.
Right. If the dollar is making a new high, but bond yields are dropping and gold is rallying, they are fighting each other.
The signal is fractured.
Stand back. Do not deploy heavy capital when the cross-asset signals are fighting.
The overarching goal here isn't to perfectly predict the future, is it? We aren't trying to be crystal ball fortune tellers.
No. Prediction is a fool's errand in global macro.
What's the real goal, then?
The goal is structural awareness. You just want to know where you are standing on the map at any given moment.
And knowing your location changes how you act.
Completely dictates it.
Let's break that down. If you use the framework and identify that you are in an early-stage campaign, the stealth phase, how do you act?
That requires pure conviction.
Conviction.
You have to deeply trust your read on the structural divergence, even when the daily price action looks incredibly boring and choppy.
You have to sit on your hands.
Sit on your hands and let the institutional accumulation work for you.
Okay, what if you identify you are in the mid-stage, the momentum phase?
That requires rigid discipline.
Discipline because it's moving fast.
Right. Don't get shaken out of your position by the sudden spikes in volatility, but also don't get overly greedy. Ride the wave, enjoy the profits, but mathematically know that you are late to the structural party.
And if you realize you are in the late stage, the saturation phase,
That requires extreme restraint. Because the absolute hardest thing to do in trading is to physically not hit the buy button when the daily trend visually looks the strongest it has ever looked.
because all your instincts scream buy.
But structurally, that is exactly when you get hurt the worst. You need the maturity to know when to leave the party while the music is still playing.
Wow, it really changes the entire game from just blindly guessing the next number on a screen to actually understanding the mechanics of the machine.
It is the fundamental difference between gambling at a casino and operating as a professional.
Let's wrap this up. We've gone on quite a journey today.
We really have.
We tracked the entire life cycle.
Yeah.
From the quiet, stealthy accumulation of smart capital to the loud, crowded, euphoric narrative, right through to the quiet, choppy exhaustion of a finished move.
It truly is the life cycle of global money.
And the final philosophy here, the thing I want to drill home. Currencies do not move because of the stories we tell on TV.
No, they absolutely do not. They move because massive amounts of capital structurally have to move.
The chart we look at is just the footprint of that journey.
And the news story is just the convenient caption we write under the picture after it's taken.
Exactly. I want to end with a forward-looking perspective here, because we are currently entering a very weird, unprecedented world globally.
Highly fragmented.
Right. Fragmented geopolitics, radically changing interest rate regimes across the board, entire global supply chains physically moving across oceans.
Which means the nature of these campaigns might begin to change shape.
In what way?
Well, in a world that is suddenly less globalized, maybe capital is forced to move harder and faster between fewer trusted jurisdictions.
The moves become more violent.
Or conversely, maybe as global supply chains literally restructure themselves over the next 2 decades, these macro arcs become even longer.
Imagine a currency campaign that lasts 5 straight years, purely because it takes exactly that long to build new semiconductor factories in a new country.
Exactly. The actual timelines of the phases might stretch out significantly.
Like the underlying rules.
The mechanics, the anatomy we discussed today, will remain exactly the same. The fundamental laws of supply, demand, and liquidity do not change just because the politics do.
So the next time you are sitting at the airport and you look at your phone and you see a breaking headline paired with a massive price spike on a chart, I want you to pause.
Take a breath.
Don't immediately ask, why did it move?
That's the trap.
Ask yourself, is this the loud start of a news story? Or is it just the messy middle of a massive structural reallocation?
That is the question that actually pays.
Expert, thank you so much for peeling back the curtain on this machinery today.
Always a pleasure to be here.
And to you, the listener, keep digging deep. See you on the next one.
Stay curious.